This metric can easily be calculated, and you can also find this on the in the annual report or on the company website. So you can also find it on the stock exchange website. So in regards to return on equity, it will give you a measure of how good the company is with respect to investing its money into new projects. So take a history of the return on equity, and it should be above 10 to 15%, right? It depends on industry to industry. However, if you want to check out how to calculate return on equity, you can visit my website equityland.com/blog. There are articles on this. Thirdly, so the higher the return on equity, the better the company, the better the ability of the company to allocate its capital. The reputation of the board of directors is another thing which you should be checking. So when you open the annual report, there are names mentioned of the board of directors. So you can easily Google them and see their interviews. What is their reputation? Do they have any past criminal records, or which other companies have they served on the board of in the past, and what is their history? Do they have a very strong ethical history, or if they don't, or they have been crooked in the past? If it's tainted, then stay away. Okay, so that is about analyzing the trustworthiness of the management and the ability of the management. Step number 4 is finding the intrinsic value of the company. Now, this is one of the most fundamental steps, but the steps before this were a precursor for this step. So in this step, you will be finding what the per share value of the company. I'm not talking about the price, but the value of the company. And that will act like a benchmark of whether you should buy or sell the company. So in order to find the intrinsic value, you need to understand what value investing is. Now let me define it for you. Value investing is basically finding companies which are undervalued and investing in them. By undervalued, I mean which is below the intrinsic value of the company, which we will be calculating. Basically, it means finding a 100 rupee note selling for 75 rupees and then buying that. So you can sell it again for 100 rupees. So this generally, it happens more often than not in the stock market. So you find companies which are worth 100 rupees and are selling for 75 rupees per share. Now, once you find the intrinsic value of the company, it becomes little easier from then on, because if it's below the intrinsic value, then you should buy. If it's above the intrinsic value, you should sell the stock. Now, what is intrinsic value? Intrinsic value is basically, it's nothing but how much cash the company will generate in its lifetime. So for example, you can calculate how much amount of cash Colgate will generate throughout its life in India, and then you can divide it by the number of shares which are trading in the market, and you will get the per share intrinsic value. So let me give you a better example.